Welcome to SF Commercial Property Conversations with Bruce Bean, where Bay Area investments meet expert insights. Get ready to unlock the strategies of commercial real estate success.
Today we're talking with Paul Levine, and Paul is a CPA, but he is now a practicing commercial real estate agent, and he has many specialties that are very well assisted having a background as a CPA. So Paul, it's great to have you on. Actually, I'd like to know how you got from wherever you started to how you are where you are now in terms of your practice.
You're gonna love this. I went to school for accounting, so the big thing was I was going to be a CPA, and I was. I became a CPA, believe it or not, in 1970, and I did that for over 50 years. And I was married to a lady who wanted to become a loan officer, and you have to take the realtor's exam. And she was from China, so she didn't yet, well, she did not have a California driver's license yet.
Oh,
So I had to drive her to the test. And if I was going to sit there for 2 hours, I was going to have to do something. So I decided to spend about an hour or two, coming up with reading her books. And then I drove her to the test. I was registered. I took the test and I walked out. I passed. So then I decided I'll go into real estate.
well, wait a minute. Did she pass?
Yes, she did.
Oh, good. Okay. All right.
But
Well,
the funny thing is, in our first transaction, which was residential, uh, we had a couple that was looking at a house, and the wife looked up and said, "I don't like the crown molding," and I wanted to kill her. So I said, nah, as a CPA, I dealt with owners and managers. I want to do that again. So I went to commercial real estate.
So did your wife at the time stay in residential?
Well, she stayed and she still is in being a loan officer. She does
Oh, that's
mortgages,
interesting. Oh, I see. Okay.
and the interest rates are not fun right now. So she's not a happy camper.
Oh, yeah. No, they haven't quite come down very far at this point.
No, they haven't. And the Fed even held them stable this month. So our best shot is the 15th of March.
Aha. Yeah. Well, I suspect Mr. Trump will have some influence there, but we'll see.
No, really?
What will the future bring? That
You
will be very
betcha.
interesting. That will be very interesting. So tell us a little bit, given your CPA background, you are a specialist in cost segregation. So for those that are listening, can you explain cost segregation and what the advantages and maybe what the disadvantages of that are?
Not a problem. First thing I want to say is I'm not just a cost seg person. I have 50 years of background as a CPA. I know income taxes inside and out, and I know all of the tricks and can save you lots of money when purchasing real estate. That being said, when you buy real estate, you buy three things. You buy the land that assumingly is not going anywhere, except if you're in an earthquake in Southern California, then you're not sure. But the IRS says it's not going anywhere. So it's not depreciable, and you just keep it forever. The
Okay.
second thing you buy are the walls and the floors, the four walls and the building. That's called the structure. If that is residential, you depreciate that over 27 and a half years straight line. If that is non-residential, you go for 39 years straight line. Then the other thing you buy, the third thing, is tangible personal property. That's the crown molding and the cabinets and the appliances and the doors and, believe it or not, the shrubs and the pipes. on the inside of the walls. You can't imagine what we do in a dentist's office. I mean, there are pipes all over the place to set it up, to get their setup.
Right.
So all of these things are tangible personal property. And all of these things can be depreciated over 5 or 15 years. Also 7, but that's not a biggie. And you can use accelerated depreciation.
Not straight line.
Not straight line. So you take more in the beginning, reducing your income taxes, creating cash flow. The other thing you get with tangible personal property is something called bonus depreciation.
Wow.
Bonus depreciation was up to 100% of $1 million that you could deduct in 1 year.
Wow.
Then that was in 2022. 2023, it was 80%. 2024, it was 60%. 2025, it's 40%. It's being phased out. But that gentleman who you referred to before,
yes, that other guy, that Don guy.
yeah, that Don guy, we think that he's going to extend it to be 100% again. That's our guess.
Yes, right. That makes sense.
Yeah, because he's looking to reduce the taxes of the ultra wealthy.
Aha.
And by taking bonus depreciation of $1 million in 1 year, that sort of helps a little bit.
A little bit here and there.
But don't remember, you got 3 things when you buy property. You've got the structure, you got the land first, then the structure, and then the tangible personal property inside and out.
So cost segregation is that you segregate each of these items, so then you can take depreciation differently for each one of them.
Correct. And I was a CPA for over 50 years. CPAs don't do a cost segregation study. Engineers do.
Oh. What
because
kind of engineer?
they know how to build a building.
Ah, I got you. So I am curious. So is the plumbing for a toilet a tangible personal item?
Well, I am not a cost segregation expert when it comes to toilets.
Okay, yes.
But I don't know. I mean,
Yeah.
they might give us, well, they would give us the toilet if they're doing the whole building.
Yeah. So but if you're putting in a dental office and you're putting in your own pipes for a dental office,
That's a different
that's your
story.
personal tangible item.
Right.
Yeah, that makes sense. Anything that you add as tenant improvements, you can depreciate differently than what is kind of there under the warm shell, so to speak.
Call it a structure. I mean,
Yeah.
the structure is one part, the tangible personal property is the other part.
Yeah. So do you have to go out and find an engineer to segregate things for you?
No, you can call me and I will work with a company, one of the biggest in the United States, called CSSI. And I will tie you up. And the nice thing about CSSI, if you give them the address, they will check out the property on the computer. Then they will figure out how much the cost segregation will save you. And they tell you how much they're going to charge you. And then you make the decision, an informed decision, as opposed to picking numbers out of the air.
So just out of curiosity, how much would this cost? It probably depends.
We've had, now realize something. You're thinking about commercial real estate, you're thinking about apartment buildings, you're thinking about office buildings, you're thinking about commercial real estate, in my mind, is any real estate that generates money on a regular basis. Okay?
Right. Yeah.
And probably one of the biggest avenues for that is renting out single family homes.
Ah, okay.
And we've had cost segregation studies done on single family homes, and they would run somewhere around $4,000 or $5,000.
Uh-huh.
They
Okay.
would save you 20.
Yeah. So you spend a little bit to get a savings of 20. So I'm curious, just speaking of single family homes, renting them out, I assume that if you're renting out to Airbnb or one of these online services, that would still count.
Yes, just go by my definition,
Yeah.
any piece of real estate that generates cash on a regular basis.
Yeah. Okay. You got the rental coming in, whether it's an industrial building or a residential building or a single family home,
Or
whatever.
an airplane hangar.
Whatever it
Start
is.
out small and then, an airplane hangar is big, but you would do it there as well.
Whatever's getting rent. Now,
Obviously.
what if you rent it yourself?
No, you're not real estate.
Oh, that's okay. That's it. If you're renting to yourself, you're not real estate.
It depends on which business you're talking about, and
Well,
then we can have a separate
well,
discussion about
I guess that's true. If you're own the building and you rent it out to your company, that's a different question altogether.
No, it isn't. That's still renting it out. You happen to be the owner of the building. Many people do this.
Yeah.
You rent it out to the company, your company, and you derive the benefits of cost segregation and other things. Remember, we're talking about cost seg because that's what we wanted to do here. But don't forget 1031 exchanges. Don't forget installment sales. Don't forget lots of other things that you can do with this real estate income tax wise.
Well, you have had some experience, obviously, with 1031 exchanges. I think you've got some stories there to tell us.
Well, I've got one that was really nice. One of my good friends had a property in the mountains, and he sold it and wanted to buy something in near near Las Vegas. And so he sold the property, and he had $131,000 of cash that went to what's known as a facilitator, somebody who holds the money. Because
Right.
on a 1031 exchange, you can't look at the money, you can't touch the money, you can't smell the money, you can't do anything with the money. So the money was kept by a facilitator. And then my friend had a realtor, and they found a house in Henderson, Nevada.
Yeah, outside of Vegas.
And the realtor called up the facilitator the next day because they wanted the money transferred to the escrow.
Yeah.
And the facilitator went bankrupt.
Oh no. Oh God.
So I get a phone call, and now we have to figure out what to do. Well, the facilitator went bankrupt. That means that my friend had what we currently call, or usually call, a casualty loss.
Uh-huh.
Well, I got to tell you something. $131,000 casualty loss doesn't do your tax return a lot of good. It screws it up royally.
Wow. Okay.
Or it did before they changed the law. And so we took it as a casualty loss. It wasn't a good thing, but at least we got the deduction. And then they got a check the next year. So what I did was I amended the first year's return and made the casualty loss smaller.
Uh-huh. Okay. Yeah.
And then the next year comes and they got another check. And I went back and I amended that tax return, made the casualty loss smaller. Then they got another check, and I said, find out what the story is. And the story was that they're probably going to get just about all of their money back.
Wow.
So what I did was I set it up as an installment sale. They got to check 1 year, they got to check another year and another year, and they didn't have to pick up all of the income at once.
Oh, wow. Okay.
30 days after I filed all of these amended returns and and that year's returns, The IRS came out with a pronouncement telling them to do exactly what I said.
Oh my gosh. Wow. You led the way.
You betcha.
So are you still doing tax returns?
Not really. I work with the client's accountants and tell them how to do it.
Oh,
Oh, well, I'm not a CPA anymore. You started out by saying that I was a CPA. When I went to real estate, I just wanted to do real estate, but with my income tax background, nobody. I tell people that I have more income tax education, knowledge, experience, creativity, and expertise than anyone else doing what I do. Nobody else has 50 years of experience.
and so you can use all that experience and help the clients go through the whole process.
Right. And also, as long as I'm doing that, I can look at their older returns and tell them if their accountant is doing a good job or not.
That's fantastic. That is great. So where would people get a hold of you?
Well, I think you have my name and telephone number and email address across the screen. So my name is Paul Levine, spelled L-E-V as in Victor, I-N-E. My telephone number is 818-298-4000. We make it easy for you.
Very,
What?
very easy.
Yes. My email address is plevinerealtor@gmail.com. And just do me one favor. If you call, do me two things. If you call, please call after 10 a.m. And also text me the fact that you're going to call. I will set you up as a contact. And instead of coming up as just a telephone number on my phone, it'll have your name, which I will expect. Because I get so many spam phone calls a day, I don't answer it if it's only a telephone number on the screen.
I understand completely. So
Well, I worked out this system and it seems to be working nicely.
that is fantastic. So just for fun to end the conversation, you said you told us what your favorite sandwich is.
I said a BLT, but when I say a BLT, I got to look back and say my mom's BLT.
Oh,
One of the best
okay.
BLT sandwiches I ever had, and unfortunately, she passed in 2012.
And you said you'd love to have this BLT with Arnie Palmer.
You bet. I'm a big sports fan. I like, most sports, but Arnie is something. He's more than a sports figure. Arnie is the king. I'm a basketball fan also, and they call LeBron James the king. Wrong. The only king in sports is Arnie Palmer.
All right, we're gonna take some comments on this when we get this out to social media and decide, is it LeBron James or is it Arnie Palmer? So I think we'll see if we can contest this in one way or another.
I'll tell you one thing. If you're your age or mine, it's Arnie.
Oh, definitely. Yeah, definitely. Yeah, no doubt about it. The king for sure. Well, it has been very fun, Paul.
Thank you so much.
Thanks for being here. That was very fun.
A pleasure.
That's a wrap on today's journey through the SF commercial real estate scene. Ready to share your story? Visit sfcommercialconversations.com/guest. Your insights could lead the next conversation.